We have with us a very special guest, the Deputy Governor of Reserve Bank of India, Mr. SS Mundra. Mr. Mundra, thanks so much for giving ET Now your time. First of all, let's straight away jump to the burning issue, that is the non-performing assets issue and the stressed asset issue in the banking sector. What is the roadmap for meeting that bank balance sheet cleanup target of March 2017, Mr. Mundra?
If there is a problem, then it is better to acknowledge the problem. Pretending and extending is not going to really help. So, we know there are problems, the leverage issue in the corporate, several reports are there, all the figures are known. So in that process, the last measure had been about the SDR. Now, I must say SDR would not be, I won't say it is the best solution, but I would say the second best solution. The ultimate way forward should be a overarching bankruptcy law kind of thing, and with a very clear roadmap and efficient execution, so that a corporate in distress can enter into that mechanism and come out also as quickly as possible, and then all the related stakeholders will have to take their share of pain. So of course, right from starting with the borrower, lender and also the exchequer, it gets distributed like this. So, and hopefully that should come in place shortly, but pending that, yes, SDR mechanism has been. Now, SDR, what does it do? It clearly shows that the corporate or the case which we are talking about, there is a mismatch between the debt and the repaying capacity.
Of course.
The revenue which comes is not sufficient to repay the debt.
Mr. Mundra, do you think it's working out? Because none of the SDRs, but I know that there's 18 months given, so only after 18 months we can say. But there are many issues that have cropped up, and bankers have also really highlighted that there are many issues. If they take over 51% stake in a company, what I've also heard is that no strategic player wants to come and buy out that stake from a banker and spend money, go for an open offer if there is a listed company, and then spend all that money and then spend more for the revival of that asset. Now, is there a SpiceJet kind of a situation where at a throwaway price you buy and SEBI gives you a waiver from open offer and money is infused for the revival? Don't you think that is turning out to be a better play? And we have seen SpiceJet also turn around, rather than an SDR where strategic players would have to spend a huge amount of money and they clearly don't want to do that.
Of course, I won't go into any individual cases because each case has a different circumstances, but ultimately, whatever framework comes, it also has to ultimately, from the bank viewpoint of Reserve Bank of India, what you are designing is with the lender in focus. Okay. And if you recollect, when the whole SDR framework was being discussed, that was the basic fundamental point, that what RBI is looking at and what SEBI is looking at. The lenders being in center focus, minority shareholders being in center focus, and finally what was discussed was something a way forward, which is taking care of these two constituencies. Whole point of SDR is ultimately it should result into a workable solution. It is a hopefully it is a resolution mechanism, it is not a postponement mechanism. So I think that is the first fundamental issue which is to be understood.
Yes. And do you think it's going that way, or it's becoming a postponement mechanism because provisioning is so low?
I mean to say it will be jumping too early to conclusion or taking the extreme positions, because recently introduced few cases have happened in these cases, and we have mentioned several times that we are keeping a continuous close watch over it. Our department on random basis will also keep on examining the individual cases which are announced and look into the details whether they are following the framework. So I think we in all fairness, we need to give some time, to this entire thing which is happening here.
So, Mr. Mundra, you said that this is the second best option, while the bankruptcy law is being the bill is being deliberated upon. If that comes, and if SDR hasn't worked in those companies, then do you think that it will replace the SDR mechanism of solution, and that bankruptcy law will be the one which will really take the precedence over all these companies, a bunch of companies which have gone under SDR?
No, see, obviously, as I said, if there is an overarching legislation, then whatever all other mechanisms are there. If you look even from a different perspective, bankruptcy law is ultimately picking up from so many existing legislation sitting and here and there. SDR is a regulation; it is not even a legislation as such. So, and even if there is no bankruptcy law, let's presume for the sake of understanding, and after a period of 18 months there is a case where ultimately SDR mechanism has not reached to the intended conclusion, then what will happen? You again go back with the available whatever mechanism is available and proceed further in the case. So, instead of that, now there will be a overarching legislation which would be available. So, obviously, it will flow into that.
Okay, and in the meantime, while bankruptcy law is being deliberated upon, we really don't know. We are hoping that in the next 3 months it will be passed. But in the meantime, do you think that some of the discrepancies that have been mentioned in SDR, there are certain problems and issues which have been experimented upon, hasn't worked out, they can be changed? There could be tighter rules and guidelines on SDR front as well?
See, we have mentioned several times, this is something recently introduced, and I just won't deny that there can't be a room for improvement, or there can't be some of the issues which we might not have realized when the framework is put in place. Ultimately, some of the things you start knowing only when you really embark on that path. So, obviously, it would be open to if there are those things, they can certainly be looked into. Even personally, if I look into it, even in the existing framework, it is not a policy view, or it is not something which I have a definite conclusion I have reached. But I would say even if everything is worked fine, and at the end of 18 months, why there should not be a mechanism whereby the lender should be able to share the upside when it comes in future?
Okay.
So why should not? It is just a thought, but of course one will need to think through it.
Let's come to the overall bank balance sheet cleanup bit, and RBI is really focused on that. There was a high profile meeting with all the bankers as well, and on that roadmap was also discussed. Now, bankers are of the point of view that they are sticking to the guidelines as per the accounting norms, while RBI has stated that there is inherent weakness in a list of over 100 corporates that have been mentioned, which could be truant borrowers, and there has to be aggressive provisioning. How will this be implemented, Mr. Mundra, if banks are really sticking to the guidelines? So, is there any tightening of norms that is expected?
Let me make a very emphatic statement that whatever we have suggested to the bank, it is exactly as per the existing IRAC norms and as per the regulation. So, we live in a framework of rule based regulation. Whatever we are talking about is within the framework of rule based regulation. Now, what has changed? The process has changed completely this time. The supervisory process and inspection of bank in RBI used to be a long activity happening at different banks from time to time. And sometimes the time differences fail to bring the interconnectedness. Interconnectedness is an issue within the regulation. It is not any kind of long drawn principle. It is very much within the framework of regulation. We separated the process this time, and the entire asset quality across the industry was done at the same time, and which must have brought some issue of interconnectedness, and where this kind of confusion which we are discussing comes. I think You have been in the field of finance for a very long time for me to explain you what I am trying to say. You are understanding it. So, that is one part of it. Now, the roadmap of 2017 and incremental provisioning which we are talking about, yes, that is something which can be taken as a proactive measure to bring the strength. In the sense, you see forbearance has ended. Okay. From April onward, if there is a case, there is nothing like a restructured portfolio. It straightway falls into the NPA. You have a stock of restructured portfolio which is sitting and with a very low provisioning. Now, if you create a roadmap where these two different baskets from the same variety of animals is reaching to a convergence, I think that would be needed as something as bringing the strength to the balance sheet.
Oh yes.
So, I think this is how we should understand the two things.
Of course, very well put, and that's becoming clearer. But what I did want to also understand is that the IRAC norms, is there any room for strengthening it further? Because income recognition on one part is something that could be an issue. Even SDR has income recognition, which a lot of people have sounded off is not right when you're looking at a solution. And on the other hand, asset classification again has not been as prudent or aggressive as the RBI would like it to be. So, is there any room at this point for strengthening that further?
If you look at it, the IRAC norms as we have prescribed are pretty stringent even compared to many global regulation. I think they are quite strong. So, the whole point is the very efficient implementation of the norms as they are. So, I think what will be more important is to ensure that the norms are adhered to in all its right components, rather than trying to look that what further you can change the norms. That is the I think that will be the road forward. And again, as you know, even within Basel III, there are few things which are still agenda under discussion. So what that brings, we will have to keep a watch for that. Moreover, in couple of years we will be moving towards the new accounting regime.
Yes.
So IFRS will have its own set of treatment. So I think we will have to do a regulatory engagement to see that when these changes are happening, how the existing set of regulation get converged with the emerging issues. I think that will be more relevant at this point of time.
What exactly got discussed in that big meeting that you had with the banks as part of the roadmap to achieving all this?
Essentially, meeting gave the same message that the whole exercise has been done. We have reached to a certain findings which we have discussed with them. And the message was very clear that if there is a problem, better recognize it, move forward. So, idea is not so much to discuss that whether there is a problem or not.
No.
I think that was not the that was not the agenda of discussion, and no one was telling that there is no problem. So if there is a problem, recognize it. If there are cases where maybe ultimately, I won't say that the RBI team would never miss anything. We are all human. So if something is genuinely missed out or there is a strong case, they were given that opportunity also to discuss, and more to prepare them now, prepare for what it entails, the capital requirement. So work in that direction. What could be the other method whereby you can bring strength to your balance sheet. So those were the, I think, broad spectrum which we were discussing in that meeting.
All right. So you did say that we'll focus on implementation of IRAC norms more, so that the discrepancy between the regulator and the banks in recognizing some of the inherent weakness in some of the accounts is not there, and also discrepancy between banks themselves who are part of the same consortium and lending to the same borrowers. How will these two discrepancies get addressed? Is there a more concerted effort towards that, or is it only going to be a focused usage of the guidelines which are already in the system?
See, one is, again, I mean to say, if you are indicating that if banks are in consortium and it should become across all the members, that is not the intention, and that is not what the rules also prescribe. The one point is there should be a better sharing of information. And at least this can be said that even within a set of lenders, if there is a clear fail to repay within the prescribed period, while the payment is on in other cases, at least it reflects that there is a weakness. Yes. There is a weakness. So other lenders do well to at least keep a close observation that this weakness does not convert into something even more serious. So that is the kind of thing. And as I did mention that when it happens across the industry at the same time, okay, so it enables all the people to view the account at one point of time and move in a more coordinated way. So I think that is another object which it achieves.
All right. And what about the prompt corrective action? Will there be some leeway given, because RBI clearly wants higher provisioning and more aggressive provisioning, which may bring down the bank's balance sheets below the level of PCA requirements? Is there going to be more leeway given to the banks, and how will you deal with a situation where more banks are weaker than required in the system?
Answer to question number one, we'll cross the bridge when we will reach there. It will be hypothetical to believe today that some of the banks will be breaching the PCA framework and whether we will be giving a leeway. So I think when we reach that point of time, we'll take a view what is to be done about it. Second, if the reality is addressed, and if there is a weakness which is observed in banks, just for that reason you can't say that okay, weakness should not be addressed. All the stakeholders will have to step into and address those problems. Is there any other option?
So, do you not believe, Mr. Mundra, that because of aggressive provisioning, a lot of banks would be left weakened in the system?
What is the yardstick of calling them weakened? See, provisioning, ultimately provisioning, what does it do? It doesn't take the cash flow out of your system. It rather strengthens the balance sheet. Okay. Yes. On the face of it, profit may look weak. Yes. But if balance sheet is getting a strength, if you don't declare a profit which is really not there, yes, and end up paying the dividend and taxes on that, now these are two situations. You have a high profit figure which is, I would say, is really not hard earned. You pay dividend and taxes.
I agree, and equity markets would only be better off, actually will improve the valuations of these, especially
you provide the and bring strength to your balance sheet.
The requirement of capital would also increase when these kind of provisionings would be taken. Now, of course, there is a huge gap between what the government has committed and what the banking system really requires. How will that deficit be filled, and now with ever increasing requirement of capital, all the more because of the provisioning hits?
I think government has also indicated that if there is a need in the context of that overall 70,000 which they mentioned, they did mention that if there is a need and maybe some fiscal space is available. So I think the government would be inclined to do as far as the immediate capital requirement of if the banking system is concerned, those who are needing it most. If we take slightly mid-term view and long-term view, then this entire thing of bank bureau and the capacity of banks to raise the capital, see, quite a few things will happen together.
Yeah.
One, you address the immediate problem, there is a certain level of capital. It brings strength to the balance sheet. If it brings strength to the balance sheet, it enables the bank to tap the market at
Yes.
some point of time. If you tap the market and you improve your CET level, it brings you related capacity of raising more in the remaining tier 1 and tier 2 capital. All these things, they are all levers which are engaged with each other.
Of course.
One piece where RBI can do something is about the existing framework, whereby could there be a possibility of giving some avenues whereby bank can either raise the capital or conserve the capital.
Capitalization is one thing, and as a solution to the aftermath of taking that high provisioning that RBI has asked the banks to take, is there a case also for consolidation that has been talked about so much?
See, some consolidation has already happened in private banks, and that consolidation is driven more by the synergies as you can come. Still there is a lot of room because we have all variety of banks. So we have so-called old private sector bank, new private sector banks, public sector bank. So that those again there are the different dynamics. Within public sector bank, a realistic thing to say would be, while it will be very important to look at the synergies. So consolidation has to happen for the right reason. Now, there is no point you consolidate a weak bank with a strong bank, and in the process both end up being weak. That is not a good thing. Or weak and weak but without realizing any synergy. So a consolidation of this kind should either enhance the geographical reach or the product range, that kind of thing. But having said that, in particular respect of this segment, ultimately it will happen where the owners will have to somewhere come into the picture and give a nudge. While is a good thing that it should happen from within and board level, and that should also happen. But I think to trigger that process, the ultimately owners will have to give a nudge for that to happen.
And of course, the big question also on the banking sector had come to light also regarding the money laundering, alleged money laundering scam in which several banks, including Bank of Baroda from where it emanated, really has come to light, and that is under investigation. How far has it reached? How much RBI has really taken cognizance of that? Are we expected to hear something on that one?
No, I mean to say the pattern after the investigation pattern has become quite clear, that one thing we should appreciate, the first tense the thing was discovered by the bank's internal mechanism only, and they flagged the issue. Now there are two issues to it. One is the gaps in the existing framework which allowed some of the people to exploit that. So that is something which is being worked on, because if you recollect, in the area of import there was a complete already the digitization and information flow which had been put in place by RBI, and now the export transaction, the similar thing. So that is a long term address to the issue. In the existing case, pattern is known, and already a forensic audit has been being put in the case, and once all those details are known, then further action would be as required, regulatory action would be taken. But important is to bridge the gap. That is why I think apart from whatever happens at the branch unit, it will be very important for all the banks to have a very strong central surveillance system, and today it is possible with technology. So you do your traditional inspection, branches do their work, but to have a more real time sense of whatever is happening, a central surveillance, a very strong team, and I think this is the message we have given to all the banks.
All right, look forward to that, and wish you a very happy New Year.
Same from
Thank
here.
you so much.
All the best.
Thank you.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.